This video describes a brief introduction into Chapter 13, which describes the standard capital asset pricing model, or CAPM. So CAPM was the first equilibrium model developed, but the issue with it is it has very stringent assumptions which may not hold in the real world. However, even with such stringent assumptions, the model did do a pretty good job. It still does a pretty good job of describing prices in the capital markets. So, although some of these assumptions that I'll be discussing may seem unrealistic, the model actually holds in that it does its job of predicting what the returns could be, or doing a pretty good job of predicting those returns. So let's go into some of the assumptions. The first one says that there's no transaction cost, which means that there's no cost of buying or selling any asset. And at least up to not so recently, or pretty recently actually, there was a cost associated with buying or selling assets. You couldn't do so for free. Even if there was a cost of saying $5 to buy or sell shares of 100 blocks of 100 shares, there was still some cost. And so now that's been eliminated with stuff like Robinhood and so on coming up. There is no cost of buying and selling assets. But back in the 60s, this was a pretty stringent assumption. The next one is that assets are infinitely divisible, which means you could sell any size of those assets. For example, let's say you only wanted to sell a tenth of a dollar's worth of IBM, you could sell or buy that amount. You didn't have to buy one stock of IBM or one stock of Berkshire Hathaway, which costs thousands of dollars. The third one is that there's no personal income tax, which already we know that there is personal income tax in the whole economy. So that is also does not apply. Uh, this one says that individuals cannot affect the price of stocks through their buying or selling actions, which means that it's a pretty liquid asset. We're assuming that all assets are pretty liquid. If you buy or sell a stock, it's not going to cause the next stock that's being sold of that same firm to go up. Let's say you bought a stock for $50, that does not change the value of the stock, which makes the next time you want to buy it $51. That there is enough flexibility that the market is absorbing those prices. Uh, you're making decisions solely on the basis of expected values and standard deviations. Uh, that means you're using the mean variance portfolio theory we've discussed throughout this semester. Unlimited short sales are allowed is the sixth one, which means you can short any number of shares. Seventh one says that you can have an unlimited lending and borrowing at the risk-free rate, which again is kind of not realistic. The bank won't let you just borrow an unlimited amount of money with no risk at all. You have to pay some interest on top of that rate. Uh, Assumptions 8 and 9 say that there is a homogeneity of expectations, which means that all investors are believing the same values for mean and variance of returns, and they have identical expectations concerning the inputs into the models that are coming up with mean and variance. And 10th says all assets are marketable, which means it's saying anything, including, even if you think about it, human capital. Any asset you want to do, you can buy and sell. So it's kind of a very intense model if you think about it that way. But anyway, there were these researchers, Sharp, Lintner, and Molson, who came up with this model. Using these assumptions, they were able to come up with this model and make life easier for everybody doing finance into the future. So there's an intense, deep derivation given in the textbook. I'm not going to go into every single detail, but rather I'd go into some of the highlights and come up with how the model is derived. Okay, so first of all, if you read the whole explanation in the textbook, it says that all investors, it boils down to all investors holding only two portfolios or combinations of these two portfolios. One is the market portfolio and one is a riskless security. So if you remember from the first chapters in this semester, when riskless lending and borrowing is allowed, so if this was the efficient frontier without riskless lending and borrowing, once riskless lending and borrowing is allowed, we're going to come up with an efficient frontier that is this straight line that is tangential to the curve at some point. and all investors will hold that particular combination for their risky assets. Okay, and then they could do riskless lending or borrowing to move up and down this line, but in any case, they're always holding the same combination of risky assets. Okay, so this would be our efficient frontier, and this line is actually called the capital market line. Okay, the capital market line. Uh, when you combine a riskless asset and a risky asset and find combinations of them. Okay, so let's go into a little bit deeper. So now, I've moved this over. Okay, I've taken the curve away, and I'm just going to be plotting this straight line and use that line here. Okay, and then talk about it some more. So we are saying that we are holding either the market portfolio or the risk-free asset, okay, or some combination of them. And so we're going to try to find the equation of a line connecting that risky asset with the riskless asset. Okay, we've already done this in previous chapters, but I'll do it one more time. So how do we find the equation of a line? We have this as our equation of the line, right? Y equals mx plus b. M is the slope, b is the intercept, right? So we have to find something that gives us what's the intercept and what's the slope, okay, to be able to find it. In our equation, y is the expected return, okay, and x is the variance, the standard deviation, okay, the risk. So our equation will translate to the form of RE bar equals some intercept plus some slope times the risk. Okay, and that's what you'll see in the next line. Excuse me. So we need to calculate the slope. How do we calculate the slope? Okay, we're trying to find y2 minus y1 over x2 minus x1. Okay, we have 2 points. We have this point and this point. Okay, we have market, we have risk-free asset. We need to find the y2 minus y1. So y2 is going to be this whole return, which is Rm bar, right? Rm bar. Y1 is the Rf, right? Is Rf. So if we do y2 minus y1, we get Rm bar minus Rf. This whole thing is Rm bar. This little part is Rf. So if we subtract Rm bar minus Rf, we get this part, okay, the rise. And then we need to do x2 minus x1. So if you see, this point has risk of sigma m, that's the market portfolio, okay. Risk-free asset has no risk, okay, so their risk is 0. So if we do sigma m minus 0, we get the x2 minus x1. Okay, so if we look at it, it's Rm bar minus Rf divided by sigma m. That is our slope. Okay, the intercept, the y-intercept is where this line crosses the y-axis, and so that is Rf. Okay, so our b is Rf. So if we plug that into the line, we're gonna get Re bar equals the intercept, which is Rf, plus our slope, which you just calculated, which is Rm bar minus Rf divided by sigma m, times the x-axis, which is sigma e. Okay, or this is the expected return of an equity, risk of an equity when we are holding the market portfolio. So now this term has a special name. Okay, we call Rm bar minus Rf divided by sigma m, we call it the market price of risk. Okay, the market price of risk. So that was where we were examining return on equity against the risk of the equity. Now let's look at it as breaking it down into not all risk, but rather looking at systematic risk. Okay, how do we measure systematic risk? We measure systematic risk using beta. We'll do the same process a second time, and that will come up with the derivation of CAPM. So some things to remember: the market portfolio has a beta of 1. That is characteristic because we're adding in every asset ever. So some assets may be riskier in the market, some assets will be less risky than the market. When we take in the average of all those assets, we end up with a beta of 1. Okay, the risk-free asset does not relate to, has no risk at all. There's no systematic risk, there's no unsystematic risk. So no matter what the market does, the risk-free asset return doesn't change because it's not associated with the market, and so its beta is 0. Okay, so if we connect these 2 points, this one will have a beta of 0, this point will have a beta of 1. Okay, we do the same thing again. We try to find that slope and find relationships based on that. So we'll see how that works. So again, our equation this time, instead of being RE bar, we have RI bar, because we're talking of an individual asset. Okay, we're talking of an individual asset with relationship to its beta. Okay, so if we're using the same sort of equation of a line, if you think of it as y equals mx plus b, it's the same thing happening. Okay, here we're calling the intercept a, our slope is going to be b, and beta is the axis. Okay, so now we're going to try to find what is a and what is b. So again, we're trying to find what's the slope, what's the intercept, to be able to plug into this equation and find our final result. So let's look at the riskless asset part. Okay, if we plug in numbers here, we just said that the beta for a riskless asset is 0. So if we plug that number in, we have Ri. Okay, our return for a riskless asset, if we look at our curve, our return is Rf. Okay, so the mean of Rf is still going to be Rf. It's a constant. Okay, so whether you use Rf bar, is still going to be Rf. Equals A. We don't have anything for A. Plus B. Nothing changes in B. But now we know it's beta. Beta for that riskless asset is 0. So we have A plus B times 0, which tells us that Rf is equal to A. Okay, so we found our A. Our A is Rf. Now let's do the same analysis for the market portfolio. We have Rm bar. Okay, we are connecting here. Rm bar equals A. We're not substituting just yet, but A plus B times beta for a market portfolio is 1. Beta for a market portfolio is 1. So we have A plus B basically. But we already know what A is. So we know that A is Rf. So we can plug in Rf. So we have Rm bar is equal to Rf plus B. But we wanted to find what B is so that we can plug it in here. So we'll take everything else to the other side. So we have B equals Rm bar minus Rf. And so we've solved for A, we've solved for B, we can plug it into this equation. Okay, if we plug in the values for A and B into this equation, we're going to get Ri bar equals A is Rf, so we have Rf plus beta I times the B term. The B term is Rm bar minus Rf. Okay, and so we've come up basically with the CAPM. This is the CAPM. Okay, but we also call it, well, the security market line. So we had the capital market line that talks about in this relationship here. Okay, this line is called the capital market line when you relate the expected return to the total risk. And now when you relate it to beta and we find the CAPM, we call that the security market line. Now, some key takeaways when you look at this equation, the higher the beta, the higher will be the equilibrium return. So you can see that from the equation, right? If beta increases, that means the slope, this slope term is increasing. We're going to be multiplying by a bigger number, and this number is going to become bigger. That means our expected return is going to go up. And we know that through our examination of systematic risk. Okay, now once more, unsystematic risk plays no role in determining return. We do not see a term at all for anything related to unsystematic risk. Okay, everything is guided by the systematic risk. Okay, so the investor is rewarded for bearing systematic risk, but is not rewarded for bearing unsystematic risk. So there's no point in taking unsystematic risk, and why? Because we can diversify away that unsystematic risk. So once more, now let's break down our beta into what it was supposed to be and take a look at it again one more time. So if we look at our equation, we know what beta is. We've calculated beta in a previous chapter. Beta is just the ratio between this sigma IM. What does sigma IM stand for? That, remember, is the covariance between the individual asset and the market. So the covariance of the asset and the market divided by the variance of the asset, of the market, so which is the same thing as standard deviation squared, right? So we had sigma IM divided by sigma M squared. And we can break this down into sigma M squared can just be written as sigma M times sigma M. I didn't change anything there. We'll see why we're doing that. So if we plug back into this equation, we'll have Ri bar, nothing changed there, equals Rf, nothing changed there either. But now beta I, we can write beta I as sigma Im over sigma m squared, right? But we'll take one of those sigma m's and put it into this term here. So we'll have Rm bar minus Rf divided by sigma m times sigma Im divided by sigma m. That's why I broke this down into sigma m and sigma m rather than leaving it as sigma m squared, because I wanted to break this into two components. So we'd have one component here and one component here. And if you remember, we called this term the market price of risk. Okay, the market price of risk. And so we broke it down into saying there's a component with the risk-free asset plus this market price of risk times sigma Im over sigma m.